Hello investors. So we are regularly trying to find ways and means to improve the performance of the portfolio. So we were doing some very interesting piece of research where we try to find out that which are the best days in the market and when do these best days occur and how we could capture it. Because the important part is to know that which are those days that really make a difference and create the outperformance. So what we did was we actually pulled out last 25 years of data. It's a good time because there is good clean data available and you had multiple bear and bull markets. So what you can see is essentially since 2000 till now, 25 years of data. The returns in this period have been a phenomenal 1490%. But on a CAGR, it's 12.5. It's good. Definitely better than what fixed income gave you. So it's been a nice, good ride. But we were trying to wonder that which are those days that really contributed to these returns? Which are those days that made a difference? Because for me as an investor, I want to make sure that I'm there on those days. In fact, not only am I there, I need to be overly exposed to the market. So we tried various time frames and we came up on a very interesting number that for the 25 years, if you take the 50 best days in the market. So let me tell you what 50 best days are. Best days are essentially those days with the highest returns on the Nifty. So whenever the percentage returns are highest in the last 25 years, we have taken those days and we took 50 such readings. So what it essentially implies is 2 days a year, right? Which is less than 1% of the days. And when we really put this out, we realize that the major contribution in the last 25 years are just these 50 days. So what you will see on your screen is a reverse calculation where we said that in case you missed these 50 days, due to whatever reason, what would be the returns? So just to remind you that if you were invested on day 1 till today, that's approximately 25 years, you would have had a 1490% return with a 12.5% CAGR. But if you missed only 50 best days, that is less than 1%, your returns over 25 years would have been only 10% and a CAGR of 0.4 or so. So essentially your returns would have been net almost zero. So this really brings us to the understanding that over a long period of time, the major contribution to the portfolio happens just on few days. And as I said, it is just 0.8 of the total data size. So this was interesting. So we felt that, hey, let's try to figure out when these 50 days occur, what is the behavior and how I ensure that I capture these dates. So we decided to go a little deeper and look at how the portfolio would have performed. So you realize that if you miss the 50 best days in the last 25 years, your portfolio would have been underwater for most of the times, barring a little bit of a phase between 2005 to 2008 when the portfolio went negative. So to sum it up, if you miss the 50 best days, your performance would have been pathetic. Your performance would be negligible. You wouldn't have even been an investor for so long in these markets. So this really brought out the emphasis of these 50 days. Next, we decided to go and see the distribution, because it's not that the best 50 days happen every year. There are some phases when the percentage gains are higher. So in this 25 years, 2 points in time really stood out. One was 2008, in which we had 16 readings. So out of the 50 best days, 16 of those best days were actually in 2008. And the second time was in 2020, when we had 6 such readings. In fact, some years didn't even have those readings. So what was common between 2008 and 2020? In fact, these were the 2 years of the biggest bear markets. So this is shocking. It's actually counterintuitive that the best days, the cluster of best days have happened in the bear markets. So we said, let's get into these two time frames and study them deeper. So what we saw in 2008 was almost a 60% decline in the Nifty. And interestingly, at the bottom, you will notice that there was a cluster of big gains. So the gains actually came after almost a 60% decline in the index. And when I go back, I was there in the markets at that time, I realized that there was such immense global upheaval. The banking system was in question. In fact, I remember that I opened an account with State Bank of India because most of my money was with HDFC and ICICI. People were questioning the banking system. And these times of uncertainty, when leave alone going out and buying stocks, you really would not even be able to transact because the system had in fact frozen. You would not keep money with brokers. It was that bad in 2008. So statistically, it's very easy to show you the best days. But practically, we realize that these days occurred in those times when the chance of deployment would have been very, very low. After almost a 60% decline in your portfolio, first and foremost, people were throwing away stock, leave alone buying stock. And whatever was left, people didn't want to see. They just, whatever liquidity they were holding close to their heart because they were questioning the banking system. So we found that the best days actually happened in the most unlikeliest of times. And more importantly, practically the time when investors would actually deploy the least. We went ahead to the second time, which I think you must have also experienced, was as recent as 2020. COVID fall. Markets were down almost 38-40%. Right? And remember what happened then. Here there was no question about markets and valuations and cheapness. The whole issue had actually changed to survival. Lockdowns were happening. People were trying to, corner in the necessities of life. A lot of broking places, the dealers were also absent because of lockdowns. And interestingly, the biggest gains happened in that phase. So what we really learned is that theoretically, yes, the best days occur. As they say, you should buy when there's blood on the street. But in these two events, when there was blood on the street, practically we realized that it was the time when most people would not be able to participate. So we decided to even dig deeper and study what happened. So we realized that actually, interestingly, the best days came after the worst days. The highest returns came actually when the markets fell the most. We said, okay, these were two phases, 2 points in time. Let's broaden the study. We went and sorted the best days. Interestingly, the best days in recent times, the last 25 years, the Indian stock market was sometime in May of 2009. The market went up 17%. In fact, it hit 2 circuits on that day and it was frozen for the day. What happened in that day? What was that great day that happened? How likely were you to pick it up? Just to refresh your memory, what happened was that the election results for UPA 2 came out. UPA 1 was a phase which was dominated by a coalition, of course led by the Congress, but the Communists were a very, very powerful party. And when the elections happened for UPA 2, the feeling was that it is going to be a bigger khichdi. In fact, the Communists are going to come back stronger. And there was also a talk of Mayawati becoming the Prime Minister. So the market was very bearish. As I said, that point where you're least likely to invest. But next day when the results came, the Congress did very well and the left were marginalized and the market went up in circuit. So what I'm trying to share with you is that the best 50 days essentially follow the worst day of times. So as investors, it is nice to look at statistics, talk about it, theoretically make quotations, but practically I will tell you, having been 13 years in the market, it is very difficult to call. So this really comes up to my understanding or my summary or my philosophy in the market, which says that to get the best days in the market, you have to survive the worst days. it is a part of reality. Very often people think that we can time the top, exit, then buy at the bottom. Barely 10% of them get the top, and out of the 10%, barely 1% again get the bottom. So your probability of success is as low as 1%. So in this phase where India is, where we are in a long-term structural bull market, do not try to time it, because you don't know when this 50 best days will come, and when they come, you're least likely to act on it. So survival is the most important thing in our markets over a period of time. Just as the last 25 years have been great, hopefully the next 25 years will also be great. The important part is, did you survive the fall? With that, I leave you for this month. Thank you.